if you want to prove that you deserve a promotion, do the job above you.
Yeah.
And if that goes well, then like they're like, well, hell,
They can't say anything.
Peihu, I'm super excited to have you on the show here. You've had a fascinating career. You've done finance, you did consulting, you made a pivot, you did an MBA in between. And so we've got a lot to dig into today.
In PE consulting, we essentially help PE investors before they make an investment decision. We will help them with due diligence on the companies, figure out if it's a good asset for them to acquire. And then after the acquisition, we help them with post-merger value creations. Because you can buy a business that is fantastic, well-managed, lean, but if they're in the market that is contracting, there's nothing you can do about that. And I knew that some of the most important skills I wanted to develop was communication, problem solving, and client relationship building.
When you're thinking through like what makes a good private equity deal, like what are the things that you look for and you say, hey, this is going to be a good deal? Peihu, I'm super excited to have you on the show here. This is Wall Street Diaries, and this is a podcast designed for people who started their careers in finance and then built something incredible. And you've had a fascinating career. You've done finance, you did consulting, you made a pivot, you did an MBA in between. And so we've got a lot to dig into today. And in particular, I want to talk about what the world of PE consulting looks like. I want to talk a little bit about what the consulting versus finance trade-off looks like, how you made that decision, and also the role of an MBA in all of this. So maybe just to get us started out, tell us a little bit about what you do as a PE consultant at Alvarez & Marsal.
Yeah. First of all, thank you for having me on the show. You know, it's great to be here. And so for my role in PE consulting, we essentially help PE investors throughout the entire deal life cycle of the transaction. So before they make an investment decision, we will help them with due diligence on the companies, figure out if it's a good asset for them to acquire. And then after the acquisition, we help them with post-merger value creation. So what levers can we pull to increase the EBITDA of the company so when they exit, they can sell it for more money?
That's fascinating. So let's dig into that a little bit because, as you know, I worked in private equity. In fact, we worked with Alvarez & Marsal all the time. And the way we used them that I thought about it was like we broke it into a couple of different chunks. Like one is before the deal. When you're sourcing deals, you often will hire an advisor to help you figure out the industries, do like market reports, all that good stuff. Then during the deal, a lot of the like deep diligence for this, it's like you can only do so much as a PE investor. And so you have to bring on support to do diligence on certain parts of it, especially on like some of the very like technical accounting pieces. You might hire like a Big Four, and you might hire an Alvarez & Marsal for any number of things. Then afterwards, you also bring on advisors to like help you figure out how to increase EBITDA, like you're saying, make sure that you've got good returns. So let's break it down a little bit. So talk to me about like the pre-acquisition stuff that Alvarez & Marsal does and like what PE consultants do to help private equity firms figure out the right companies to acquire and the right industries to invest in.
Yeah. So I'll break down due diligence into like 4 categories. So you have commercial due diligence, you have operational due diligence, you have financial due diligence, and then you have, if it's a SaaS company, you would do tech diligence.
Gotcha.
A financial due diligence is almost always required because this is a sort of like a quality of his earnings assessment. So you're saying, hey, this company told us they made, $500 million last year. Does this check out, right? So it's more like forensic accounting, making sure that numbers tied, the books they didn't cook the books. Very important. That's something that you definitely want to make sure that you hire someone to do. Then is the commercial due diligence. Commercial due diligence is essentially saying like, hey, we're looking to acquire a company in the sewage business. Is the sewage business growing or is it contracting? Because you can buy a business that is fantastic, well-managed, lean, good cash flow. But if they're in the market that is contracting, there's nothing you can do about that, right? That's like if you were looking to shop for a home and you find this home, the home is perfect. You love it, but it's in a neighborhood that has a little bit of high crime. They just built a railroad right next to it, so it's noisy. You there's nothing you can do, right? It's just it is what it is. So that's commercial due diligence, like understanding the market that you're investing in. And then the operational due diligence, essentially looking at the company. So looking at how well it's structured, the management team, are they competent? Do they have the right skill set to take this company forward and scale? And also looking at some of their moats. Like, do they have something that's defensible? What's the competitive landscape looking like? And then lastly, the tech diligence is, for when you're buying a SaaS company, you're not really buying anything physical other than just the talent and the product, which is a software product. So you really want to understand how well is the product coded?
Yeah.
Do they have a lot of technical debt? Is it scalable? Just to ensure that when they were architecting this product, the SaaS product, it was thoughtful and it doesn't have a tremendous amount of technical debt and issues that you need to like constantly fix, bugs and all that stuff.
Yeah. And as a tech investor, we definitely worked with a lot of companies that had, terrible tech stacks. And that was a huge discount to valuation. Whereas like a PE investor, I could only afford to pay a couple turns of EBITDA less because, hey, we were going to have to change their entire tech stack. We were going to have to do a ton of capitalized software expense, have to move them onto like AWS or something. And so that's a really, really critical part that like I, as a PE investor, don't necessarily how to do. And so I want to talk a little bit more about what the day-to-day looks like, but just to make sure we've got it right. So we've got the commercial, which is basically like, what does the sector look like? What is the market? How's it going? We've got the operational, which is more about like, what is the day-to-day operations of the business? Is the management team good? Financial, which is that forensic accounting piece. And then we've also got the tech side specifically for tech deals. Now, that's a huge array of stuff to work on. Did you specifically work on all of those or did you specialize in one?
Yeah, so I would say I primarily focus on operational diligence. I did a little bit of tech diligence, but those are kind of the two big ones I did.
Okay. We'll dig a little deeper then on the operational side. Like what goes into operational diligence?
Yeah. A lot of the operational diligence, you are essentially looking at their revenue year over year. How is it growing? Is it contracting? What segment is growing? You're looking at their cost structure, like what are they spending money on? CapEx, OpEx expenditures. You're looking at their employee count. Like are they making thoughtful hires? What's the tenure? And then what you're trying to do is you're trying to assess this company against peers. So you do a lot of benchmarking.
Yeah.
So you benchmark, revenue, costs, SG&A as a percentage of revenue, and then you benchmark that against competitors that are in the same industry with the same company profile, like same revenue, range.
Yeah.
And then you can kind of get a sense of like how they fare. Are they really efficient? Do they manage their cash flow well? Are they well positioned to grow? So you're just understanding the decision that the leaderships are making and whether that is optimized.
Yeah.
Right.
Very interesting. And you're talking about a lot of different aspects that as an investor, we care immensely about to make sure that we're doing a good deal.
Yeah.
So I'm curious, when you're thinking through like what makes a good private equity deal, like when you're doing this operational diligence, you're looking at like these 10 different metrics. What are the things that you look for and you say, hey, I, as Pehu, have done this a dozen times. This is a good deal. This is going to be a good deal.
Okay. I think it starts with a good commercial due diligence, right? So if you are investing in a sector that's contracting, consumers are changing tastes, potential regulation are coming down that could really impact this sector, I would say that's probably might be like a non-starter.
Yeah.
So if you're seeing that this sector, this area is in trouble, you may want to think about something else. But let's say like everything checks out, everything looks good. You go into and let's say the financials also checks out, then you go into the operational diligence. What makes an attractive deal is looking at the fact that when you do benchmarking, that particular company is like, I would say maybe in the top quartile of its peer class when it comes to cost structure, when it comes to return on invested capital.
Yep.
Certain metrics that really shows that the company is utilizing their resources, investing their resources wisely, and that money that they're deploying is generating more return for its shareholders or boosting enterprise value.
Yeah. Gotcha. Okay. Well, that's gold right there. A lot of our students who are interviewing for private equity, they get asked the question like, what makes a good deal? And even our students who are interviewing for banking, like as the people advising on these deals, you got to know what makes a good deal. And so you just shared tons of stuff.
And I would say more specifically, if you get asked that question, you want to understand like the strategy of the fund.
Yeah.
You want to like understand like, hey, they're launching a fund for X whatever, and you want to make sure that in the interview question you're answering the question on, this is because a deal might be good for one fund and terrible for another one, right? It just depends on the portfolio of composition.
Yeah.
And I would add another piece is like you want to find, this is the second piece, you want to also find what the upside of that company is. So private equity companies, they want to invest in really good companies that have strong cash flow, but they don't want to invest in companies that are fully optimized.
Yeah.
So that's like a real estate investor buying a home that is in a good location, good foundation, needs a little bit of work, but that's easy. They put in $50K to fix it, and then they flip it for double, right? Private equity is kind of very similar, where you also really want to understand like what the upsides are. Like what are the things that you can immediately do? Like, oh, maybe they have poor go-to-market strategy. Maybe they have a bloated SG&A function where you can probably use some AI and automation to help reduce some of the workforce. So you have to also be able to articulate not only why this is an attractive company as is, but you also have to articulate what the upside potential is, so that when you sell it, you can also sell it for a lot higher multiple.
Yeah, that's so true. And like in our investment decks and private equity, we would have literally slides saying like, okay, here's what the company is. Here's what it could be.
Yeah.
Like here are the 5 things that we're going to go do and we're going to change.
And it has to be defensible.
Yeah.
Because you're the MD, the people on the call, they'll be like, hey, why do you think this is? Why do you think you can do this, right? So you can't just like,
you can't just make it up.
Shit. You gotta be thoughtful in your analysis. You gotta be realistic. Your numbers for the upside needs to be quantifiable. You can't just say like, hey, we think we can increase revenue by an extra like 50%, right? Like it's like, okay, well, how are you gonna do that? Why you come up with that number? So everything has to be defensible.
Yeah. Well, and it's not even just the MDs. Like the MDs they care about because the LPs do. Like the limited partners investing in these private equity funds. If you say, hey, I'm going to increase the revenue by 50% by doing XYZ things, then you don't do it. Next fundraise, what's going to happen? They're not going to invest, right?
No.
And so you have a down round. You're going to like go into a death spiral for your private equity firm. So one thing you just mentioned that was super interesting to me is this concept that a deal can be a good deal for one PE firm and a bad deal for a different PE firm. So talk me through what are some of the different strategies that you've seen PE firms have, and what might make a PE like deal good for one firm and not for another firm?
I would say, I think the primary thing that comes to mind is the amount of time that a PE firm want to hold on to a company. So like some PE firms, they want to hold a company for like maybe 3 years and then just sell it.
Yeah.
So in those 3 years, they don't have a ton of time to make improvements to the business. So they need to find things that are like easy to implement, easy to fix, so that in those 3 years they can say, hey, we took a company that had an enterprise value of X and we turn it, or EBITDA of X, and we turn it to EBITDA of Y. So you need to really like look for these quick wins.
Yeah.
Some other PE firms or even family offices that have a much longer horizon, they can take on a company that maybe needs a little bit more time, or their, like the rehab needs a little bit more time and resource, but that this sector is going to do well. You're going to get a good return on it. So I would say like that's probably one aspect of it. And a second aspect could be like the size of the company.
Yeah.
Sometimes the deal size is just maybe on the border of what they would consider like, hey, I think this is too small for us.
Yeah.
Just too lower middle market for us. We might have to pass. The juice is good, but it's not. We're not getting as much squeeze for it.
Yeah. And that's always frustrating as an investor, where I'm looking at a deal, I source a deal, I bring it to our investment committee, and they're like, if we've got a $10 billion fund size, like a $50 million equity check is just not going to be worth our time. And conversely, if you're working at like a $1 billion fund or something like that, and you're like, hey, I've got this massive take private I want to do. It's a $5 billion company. They're going to be like, okay, well, like, sorry. Like,
we're not going to spend 60% of our fund on one deal.
Yeah.
Right. Like it's just, we want to diversify. We want to hedge our risks. Yeah. So you got it.
Exactly. But different funds, interestingly, have different degrees of concentration. Like there's some funds out there that they want to make very concentrated bets where they're only going to invest in a dozen companies or even less than 10 per fund. But then you also get other firms out there, they're like, no, we want to do like 20. We want to hedge our bets, get like a bunch of different deals in here, and we're going to like make it very, very non-concentrated. And so you've got factors of size, you've got factors of time. Another factor that I also see coming
sector. I would say sector is another one.
Sector, that's a huge one. Yeah. And so a lot of firms specialize in specific sectors. I worked at tech funds mostly. And so that is like, if it's not tech, then like you can't invest in it. Or if it's not in like defense tech, if you're like a defense tech fund, then like you can't invest in it. Also, the orientation towards value versus growth is another big one. Have you seen anybody sort of differentiating on deals based off of that before? Or like, is that something that comes up to disqualify or qualify deals?
And just so we're on the same page, when you say value, you mean like the company's already doing well. It's got a baseline, good foundation.
I think a lot of it is like the multiples that you're willing to pay. And so I worked at a value-oriented PE fund that like wasn't willing to pay high multiples for these deals. And so if there was this high-flying company that was already great in a great industry, 30x EBITDA, like we just wouldn't pay for it. And so even if it was a good company, a good deal for a more aggressive fund that was more growth-oriented, then it's not a good deal for us.
I see. I would say like the value funds have a very strict parameter that they operate on. And you're right, they probably won't overpay for something, even if the upside could be really good.
Yeah.
Because they believe that their mentality is like, whenever we invest, we want to invest at a good price, so that even if we don't achieve any of the value creation things we achieve, we know we can sell this, a couple years down the road. And because the sector that we're investing in is growing, and we're also going to do well, we're going to be able to ride that wave. But it's not. They have this business model, and it's just like they're not going to overpay.
Yeah. There's definitely a lot of risk aversion in a lot of these funds where they say like
much more.
We want to make sure that even if everything goes downhill, we're still going to get our cash back. And some funds, they pride themselves. They're like, we've never lost money on a deal, which is very hard to do, very impressive. But it also means that sometimes they're turning down an expensive company that's just like absolutely going to the moon. And so that's another sort of like disqualification factor.
Just
I would say.
What you're willing to pay.
Just what you're willing to pay. Yeah, on a relative basis. But I also want to dig into what the day-to-day looks like for this, because at Wall Street Mastermind, we coach a lot of students on getting into banking and private equity and different parts of high finance. And it's really hard to tell what these jobs actually look like until you're on the inside. And so what does the day-to-day look like for an entry-level private equity consultant at a firm like Alvarez & Marsal?
I would say the day-to-day, I would say this is across banking, across high finance, and everything. I think your day-to-day is going to be, you're going to be like a support person for, the senior associate or the VP, or you're just basically going to get a task that you're going to be assigned to, whether it's like, taking notes on a call, doing some analysis, building models, scheduling meetings. Sometimes you might have to book reservation for clients. Like if the client's coming in for into town, or you're traveling somewhere, you might be the person that has to take care of the reservation.
Yeah.
Right. Things like that. You're just doing everything. You're just a support person. You're just like anything that the MDs, the VPs, all those people need. You're just going to be able to. You're going to take care of them.
That's fairly true I'd say.
And then once you build enough credibility and skills, where people can trust your work, whether it's slide building, model building, running workshops, if you can get to that level that quickly, then people will just kind of start giving you more and more as and just stretching you a little bit more and more, which is a good thing, because that's how you develop new skills and you grow and you evolve.
Yeah, well, Pehu, these are like timeless truths in finance, I would say, where in investment banking and consulting and any of these sort of jobs, you're always going to start out just doing whatever else people don't want to do. And so
that's a good, nice way of putting it. Yes.
Yeah, you just got to build trust and do the stuff that it's kind of the admin work and the grunt work sometimes, but it can still be interesting. Like in banking, I was working on pretty interesting models, and just because nobody else wanted to do it didn't mean that it was still not fun and interesting in some ways. And so you have to learn how to appreciate that so you can do a good job at it, so that people can trust you, so you can work your way up the ranks a little
Even
bit.
if you don't like it, just do it with a smile, do it perfectly. Because once you do that, that's how you actually get to do more of the things that you want to do.
Yeah. Well, so you've been a while away from the entry level jobs at a firm like this. And so what does that trajectory look like? If you start out of college at an Alvarez and Marsal, what does the timeline look like to get promoted up to the more senior folks? And what does the day-to-day change like?
Yeah, I'll talk about Alvarez and Marsal, and I'll talk about industry in general. A lot of firms, banking, consulting, PE, have an average tenure at each level. And I would say it's probably anywhere between 2 to 4 years at each level that you will spend. That can be accelerated if you just crush it, if you're just doing an amazing job, your work is high quality, there's very little rework or turns. But I would say it's about 2 to 4 years in each level. And that gives you enough time to, get the title, sit in that title, get the responsibility, get yourself comfortable. And then once you're comfortable, then you say, okay, how can I stretch myself and demonstrate that I'm ready for the next level, right? Because what we do, and I think that this is probably across banking, across PE as well, is that we let's say one of my senior associates says, "Hey, I want to get promoted." I'll say, "Okay, great." So this all the rest of the class, and then
that's cold right there.
And then I would say, what are the things that you're doing to demonstrate that you're ready for the next class?
Yeah,
and I want my senior associates to be successful. I want my senior associates to move up. But the thing is, if I'm the one that says, "Hey, let's promote John," and he gets that level and he fails and he's not doing well, it's gonna make me look bad too.
Yeah.
So you want to make sure that they're ready. How do you make sure they're ready? Well, start giving them work that's at the next level.
Yeah.
Make them stretch their role a little bit, and then you can say, well, this person is already operating at the next level. I think they're ready, and that's a really good, strong case for promotion.
I love that. And I think that's just kind of a general principle. If you want to prove that you deserve a promotion, do the job above you.
Yeah.
And if that goes well, then they're like, well, hell, we got to.
They can't say anything.
We got to promote you. You're already doing it well.
It's hey, I'm already doing it, just without the title and the pay. Just
exactly. Yeah.
You can't argue with that.
Got to comp me, or I'm going to go and do this somewhere else at that level.
Yeah, you can't argue with that.
Yeah. Yeah. And so you mentioned title senior associate, and in banking and PE, it's it goes analyst, associate, VP, principal, director, managing director. What does that sort of trajectory of titles look like for PE consulting?
So we have analyst, associate, senior associate, manager, director, senior director, and then MD. And then in the MD space, you have some junior MDs, and then you have more senior MDs, and the senior MDs are more like they're like more like managing partners.
Yeah.
You know, like they're like MDs that are in charge of other MDs.
Yeah.
Or they'll like run a whole practice, like TMT, or they'll run a whole sector or something like that.
Yeah. Similar structure at a lot of banks and private
Very
equity
similar.
firms.
Very similar.
And the manager title is kind of funny. That's a consulting title. And so it seems like this exists halfway between those worlds of associate and PE, manager and consulting. It's kind of funny. But okay. And if you don't mind me asking, like how does that like look in terms of a comp trajectory? Like for a lot of our students who are considering careers like this, is this a fairly lucrative field to join out of school? And down the line, if you make your way up to managing partner, is this a place where you can support a family and have a really good financial future?
Yeah, I mean, I definitely chose M&A consulting, private equity consulting, because I knew what the comp was going to be like. And, you know, for anybody that's looking for a career, what you want to do, you want to look at what are the roles and responsibilities, what are the skills required, is that aligned with the things that I want to do and the skills that I want to develop. But then you also want to get a sense of like what that salary range is, so that you know, like, hey, this is what maybe I'll make coming out of school. This is what I can make as I progress. I don't remember what our analysts make, but I think it's like close to six figure or not six figure. So you're coming out of school and you're making six figure. You know, I think our analysts have. They get everybody gets a bonus, but I think at the senior associate level, you start to get it's kind of like it's similar to like an equity share, but it's more like, you know, if you're generating revenue, like you're on a client project and you're billing X amount of hours, generating X amount of revenue.
Yeah.
The company will actually give you a percentage of that.
Okay, cool.
And so that becomes your variable comp. And then the percentage of that is determined by your rating. So each level has a range of what you can get from minimum to maximum. And then your rating depends on how much of that between that range you get. So we have a 5 rating scale. 0 is like you really didn't do anything. 3 means you met expectation. 5 is like gold standard, and it kind of goes in like 0.5 increments. So anybody should, the minimum, get a 3, because that means you did your job, you did what you're supposed to do, you hit, you know, basic KPIs, and then anything above that means you went above and beyond, and you demonstrated that you were better than just doing the kind of the
going above and beyond,
met the expectation.
Doing that thing we were talking about, working up a little bit so that people want to promote you. And
exactly.
And so that's not bad. You're making 6 figures out of school. That's pretty close to like what banking makes out of school. I think it's usually around 100 base, 110 base or something like these days for a lot of banks. And so tell me a little bit about what differentiates the good analysts from the mediocre, from the ones who just like didn't do that well on that scale.
Yeah, and before we go there, I will say, and I think banking is the same, we have, it's not an up-or-out culture, but it's a culture where, you know, each year we'll kind of look at performance and we will counsel out some of the low performers, like intentionally. Yeah. Just because, you know, we try to make really good hiring decisions, but obviously there might be some people who kind of slip through the crack. So we are very intentional about, you know, people who are not hitting their KPIs, who are not demonstrating that they're able to do the job at a high level and a high pace. Those will get canceled out. Your question was around, what makes a good analyst? So when I work with analysts, I think that one, there needs to be good leadership so that you can articulate what you expect from them, what great looks like, what gold standard looks like, so that the analyst knows, right? So I think that's the number one thing, because I think I've worked when I was coming up the ranks. I also felt like some people just expect you to be a mind reader, and you know, like they're vague when they say something. You know, I had this MD, he would write like 2 sentences and just expect you to figure it out. I think that it's good for you to, as a good leader, you need to be able to like coach, because a lot of this finance consulting, banking is an apprenticeship model.
Yeah.
Right. You're kind of watching, learning, observing what these MDs, what these senior people do.
Mm-hmm.
So what would make a good analyst is, someone who's really proactive.
Mm-hmm.
Someone who doesn't just do what they're doing, but they're like thinking ahead, say, hey, we have this meeting with this client the next day. I put together this deck. It just kind of talks to them about what are the topics we're going to talk about, right?
Mm-hmm.
I remember I had a senior associate on one of the deals, and I remember I asked him, hey, like whenever there's we run a diligence for this private equity company. And I remember asking him, hey, whenever there's new files that gets added to the virtual data room,
Mm-hmm.
take a look, and anything that's relevant for us, because sometimes the target just uploads a bunch of stuff,
Yeah.
right? Just, you're like overwhelmed. And it's like, hey, just whatever's relevant, just move it into our folder, and then just send like a chat to the broader team and just say, hey, this is what came in, this is what's relevant for us. But I found myself having to ask him like every day, hey, did somebody come in, right?
Yeah.
So I think like that proactiveness is like, hey, when somebody asks you to do something, you just do it and you're proactive. So it's like, hey, they asked me to, just check this on a daily basis. So every day I'm going to set a reminder or whatever, and just, they don't have to ask me because I'm just going to do it.
You're just going to do it.
Yeah.
Which is such a relief as a manager. Like,
Yeah.
as I've worked my way up the ranks in finance from analyst to associate, senior associate, VP, whatever, it's like, it's so much de-stressing to me when I'm working with an analyst. I'm like, hey, like if I ask you to do something, I don't have to think about it. I just know it's going to get done.
Yes.
But your brain is just like on overload if you're like, okay, I know that my analyst should be doing this. I don't know if they're actually doing it. I know that the associate should be checking that they're doing that. I don't know if they're doing that. And so you're like, you have to manage not only your tasks, but their tasks and the tasks below them too, if you don't have a good team.
Exactly. And the whole point about this is like, if you want people to give you more responsibility, more work, do whatever you're asked to do perfectly, or just as well as you can do, so that people can give you more. Being proactive about it. And it's like, you want to be able to manage up. So it's like, hey, what are the things that you want to anticipate? You want to be able to like see around the corner, because like maybe your director, your VP, they're stretched in. So it's like, hey, how can I provide more value and think around the corner and anticipate what are the things that we might need?
Gotcha. Well, so this is super interesting. And just like great advice for anyone who's trying to succeed in a career is be proactive, think ahead, like understand what they need. Now, I want to talk a little bit about how to choose a career like this and what that process looks like. And so you're kind of a funny guest to have on the show, because you did the opposite of what most of our team does, which is going towards finance. You went away from finance and you decided to go for the consulting side of things. So let's dig into that. Why did you choose to build the rest of your career in consulting after starting out in finance?
That's a very good question. In finance, I learned how to build models. I learned how to do financial analysis. I learned how to read P&Ls, cash flow statements. All that was very. I even learned, accounting, some accounting, general ledgers, accounting systems, ERPs. I chose consulting because, one, I knew I wanted to work. I chose consulting, but specifically for M&A and private equity, because I knew I wanted to work on transactions. I think M&A is super fascinating. A lot of times we work on deals that are not even disclosed, under the radar, right? Like it's hush hush.
Yeah.
I think there's like something sexy about that.
Yeah.
It's pretty fast paced. So if you're someone who likes things that are moving fast, that's also something that's a positive. But the reason why I chose to go consulting versus pure banking is because I knew the skills I wanted to develop. And I knew that some of the most important skills I wanted to develop was communication, problem solving, and client relationship building at an earlier age.
Yep.
And banking, although banking is a great and lucrative career path, you are at a more junior level. You're mostly building the deck and the models. You're not really having a ton of client interaction where you're presenting to the client, you're leading a workshop, or you're problem solving, right? And I think that consulting is a much different path, because the things that you help the client with, banking's like, hey, we're going to help you sell this company, right? We're going to help you sell it for the maximum value, and this is how we're going to do it. Consulting, there's a ton of different problems you're solving, right? On the diligence side, you're trying to help them evaluate the company to understand whether this is a good asset. After the acquisition, you want to say, hey, what are the different levers? What are the different areas where we can help increase enterprise value in EBITDA? And that's a whole different skill set, because then you're going into like, okay, like you have to, one, be able to understand, what are the strategic levers you can pull to both on the cost and the revenue side to increase EBITDA. And then two, you also need to help design a plan on how you're going to execute that plan. Right. So it's very different. And for me personally, I really wanted to develop my problem solving skills.
Gotcha. Okay. So there was problem solving component to it. There was a client relationship component to it. Like some of these soft skills. And honestly, like I can't fault that thesis.
Communication, yeah.
Yeah, I totally think that's important, especially in a world where AI is automating away a lot of the like early hard skills. The soft skills are what's left, and the communication skills. And so I definitely hear you on that. Like obviously I love investment banking. I'm biased here, so I'm going to claim that that's the best job out of school, because I do think you get a lot of those soft skills in addition to that hard skill base. But I'm curious, what would you say is the single best thing about PE consulting for someone coming out of school? Like, what would you do to try and convince someone to join PE consulting straight out of school?
I would say if you enjoy fast-paced work, and if you enjoy learning about different kind of businesses where one project to another can look totally different, if you like working with different teams, sometimes the team will get swapped out. Sometimes you get to work with the same MD and you just go from deal to deal. But a lot of times, because of timing of when deals hit and who's available, like you might work with different people. So if you enjoy that dynamic landscape, and same with banking too. The banking staffing model is very similar to consulting, actually. I would say like, and if you like problem solving, obviously, if you like, analysis, doing analysis, I would say this PE consulting is a great career for people who enjoyed all those components.
What about the difference between management consulting and PE consulting? Because prior to this, you did work in management consulting, which is also very prestigious. Lots of people love to do that. But then you decided to make the switch specifically to PE diligence, and that was driven partly because you're interested in M&A, like you said. But what is the functional difference between the role of like an early career professional in traditional like management consulting versus PE consulting specifically?
Yeah, management consulting, you work on a much broader range of client issues, and you can work with corporate clients, you can work with private equity clients. So your pool of clientele is also a lot bigger, and the problems you solve are just non-transaction problems. So they're not M&A related. They're like, we have a revenue leakage in our company. We don't know why it's happening. Can you help us figure it out? Or it's like, we want to enter this new market. We don't know which market we want to enter. Can you help us prioritize, in the APAC region, which country we should enter, right? So these are kind of the more the types of problems that you help clients solve. I wanted to do private equity and M&A consulting because I was really fascinated by the transaction life cycle. When I was working at the wealth management and insurance company, we were actually going through a divestiture. So we sold off our annuities business.
Interesting.
And that's when I kind of first got a sniff of like M&A. Before that, I was just a kid out of college. I didn't even know what M&A was. And I was like, oh, okay, this seems interesting. So I always had this mind that I was like, hey, maybe one day I'll end up in M&A or private equity. And for me, it's just really fascinating to be able to, one, work with private equity investors and on giving them an opinion that affects their decision on the deal, on the deal thesis. Secondly, you help them figure out ways to increase value of the company. So it's very strategic. You're like, hey, what are the things we can do on the cost and the revenue side? And then also on the exit side, like, hey, how can we help you get the company ready to be sold, to be exited? So I just think like the whole deal life cycle is super interesting.
Honestly, I totally agree. You know me, I've worked in M&A and worked on a lot of deals, and worked with PE consultants on a lot of deals. It's been great. And so tell me a little bit more about how someone like who wants to like make money and, you know, have a really interesting career, build those soft skills, get involved with M&A, someone who wants to do this job, like what does that process look like? How can they prepare themselves in undergrad or coming out of an MBA like you did to make this job a reality?
Yeah, it's a great question. I would say, you know, build some foundational knowledge on like what M&A is, who are the players. You know, you have typically on a transaction you have a legal team handles all the legal aspect. You have an investment banking team that handles more like the financial advisory, and they're essentially the brokerage, right?
Yeah.
And typically you need like a series, some kind of license for that.
Yep.
And then you have the advisors, right? This is where we come in, where like whether it's the FDD team, financial due diligence team, the operational due diligence team. So you have advisors on the deal. So just kind of familiarize yourself with who the players are, what happens during an M&A cycle, right? Like you have a sourcing, you know, the PE life cycle is like, hey, you raise a fund, the fund has a specific strategy, then you go and look for companies that fit within this particular strategy. Then you identify the companies, then you have to figure out which one you want to invest in. Once you invest in these companies, then you have to create value. So just understand like the whole process of what M&A is and what private equity is. And then for the non-private equity stuff, like understand why would a company like Amazon buy Whole Foods? Like understand, you know, what is the some of the intangibles, right? Because we know that, you know, the synergies for Amazon acquiring Whole Foods was much bigger than just getting into the grocery chain, right? It gave them a gave Amazon a physical footprint.
Yeah.
It gave them logistics, right? Because now they have routing and they have routes on top of what their existings are. But the physical location was a big one. Now you can go and return your Amazon packages at a physical at a Whole Foods, right? So
do that all the time.
Yeah, you have to understand like why would someone want to buy a company, right? Because then, you know, when you enter investment banking or consulting, you know, you would be able to go to your MD and say, hey, like I heard that, you know, so and so is looking to get sold. And I think that this company would be we should pitch to this company because they would be a great fit. And here's why, right? Because a lot of it is like when you're on the sell side, so you have to get a little creative. You have to understand like, okay, who will be good targets to buy this home and why, right? Like, hey, you know, you would never pitch like a produce company with like a manufacturing company, right? Like there's no synergies. Doesn't make sense, right? Like even for Amazon to buy Whole Foods, it didn't quite make sense, but somebody in their corp dev team probably saw that there was
the potential.
Some potential synergies. They looked
ahead a little bit.
Yeah, they looked ahead. So it's like understanding all these different things. So it's a lot, but if you want to be in this space, these are things you want to understand.
Yeah. When students, I think you can never start that early in terms of developing that judgment. Following deals, it sounds like, is a huge piece of it. And starting to just think about M&A, like starting to like develop the vocabulary and the pattern recognition of seeing like Whole Foods and Amazon.
Foundation.
And trying to say like, does this make sense? And like asking about it. And, you know, this week I was, to bring us into current events a little bit, I was looking at the SpaceX XAI deal that you may or may not have seen about, where they're saying, okay, like the rationale for this is that we need to build AI data centers in space, and therefore you need to have a space company and an AI company. I looked at that and I was like, okay, ex ante, that makes no sense to me. Like I know how expensive launch costs are right now, and I know how much a lot of the data center equipment looks like, and so I could be wrong about that.
Yeah, and then you gotta go service those data centers once they break. So you have to send somebody up there
Yeah.
to, maintain those data centers. So there's things that they might not have fully thought through, but who knows?
Yeah, well, and I could be right or I could be wrong
Yeah.
about that, but the fact that I've developed pattern recognition and started to think about this enables me to ask those questions in a way that you're just not going
Exactly.
to unless you've started to think
Yeah.
about it. So, without going too much on a tangent about that very interesting deal, tell me a little bit about what that interview process looks like. So, what does an analyst actually have to do to get into one of these jobs in general?
Yeah. So it starts off with, and this might all be done in a super day. So a super day is essentially like you have a day where you have back-to-back interviews.
Yep.
It's meant to be efficient. It's meant to just compact everything in one day and then be able to make a decision quickly, right? Because when you're doing campus hiring, you're dealing with a large funnel of candidates. Same with banking. So you want to make sure that you're being efficient. So a lot of the companies, what they do is they block off a week and then just have super days with candidates. What happens in these super days is that you most likely we have a kind of a behavioral assessment where they're going to ask questions to understand and more deeply like how you think and how it's like, hey, give me an example where you overcome a challenge. Give me an example where you work with difficult people and how did you navigate those things, right? Because they're going to understand like, what if you're on a client, the client's difficult? How are you going to manage that? What if you're on a team and there's different team dynamics? How are you going to navigate that? So there's one behavioral piece, and then there's going to be more quant piece. So they might give you a case where it's like an Excel modeling test that they're going to have you do. It's like, hey, like this is the situation, this is the potential deal. We want you to create a model that kind of helps us evaluate how much this company should be sold at, right?
Interesting.
And then you have to build a model, explain why you came up with the model, and then you have to also explain your assumptions.
Yeah.
Because a lot of it is going to be based on some of the
Yeah.
assumption that you make. And then there might be like a write-up portion where you put together a PowerPoint to like an investment committee and you say like, this is the model we built, this is who we think would be targeted, and here's why. And it kind of showcases your critical thinking abilities and how you tie the model to something more qualitative and also your presentation skills. I know like at a more junior level, you may not do that, maybe VPs and above will do that in banking, but it also kind of gives them an understanding of like, is this someone that we can groom and we can coach and
Build that talent,
build that talent as they kind of rise up at the firm.
I love that. And that's actually extraordinarily similar to the PE recruiting process. Like, I don't know how familiar you are with that, but it's the same thing. You've got to know the behaviorals. Like, why are you interested in this firm? Why are you interested in M&A?
Yeah.
And tell me about yourself and like, how does that all tie together? And then you got the technical components of like accounting and like rationale around deals and things like that. And then also these modeling tests where you build a model, you put it into PowerPoint. And so that's remarkably similar. And I guess that makes sense if you're working with PE firms all the time, that it would be kind of the same recruiting process.
Yeah, and they might even ask you like a curveball, say, hey, tell me about a recent deal that you saw in the news.
Yeah.
And what made you, what stood out to you, So you also may have to keep a pulse on the market, what's happening, right? But I think they just want people who are genuinely interested in the space and not just chasing it because it's a well-paying field, but people who actually find this field interesting and
Okay, well, I've got a couple last sort of random questions that have just been digging into my brain this entire time. And the first one is what the line is between the PE firm and the PE consulting firm. Because as a PE investor, like I think it's my job to say, hey, like I need to know everything about this business. I need to know every in and out, all the details about the operations, the financials, the tech and things like that in order to make an effective investment decision. And so it sounds like a lot of the times PE firms are outsourcing that intellectual labor though. And so to what extent do you think that that's like fair? That's a good idea for PE firms to hire PE consultants. Is this necessary or is this lazy?
I don't think it's lazy at all because as a person on the deal team, you have to evaluate a lot of deals. And then you may also not have the depth of knowledge that like a consulting firm may have when it comes to a specific sector and a specific way of doing diligence, right? Because like we do these, so like if you're outsourcing that intellectual labor to like an expert company who do these day in and day out, they're going to be expert at this versus you're doing maybe once every, whenever you think a deal is going to be worth it. Because a lot of the deals that come in the top funnel are going to get filtered out. They don't meet the criteria, right? And then whatever happens at the bottom, it's like, okay, we want to look at these four, and out of these four, we're really interested in these two, right? So I don't think it's unnecessary. I don't think it's lazy. Some of the PE firms who are much larger, so like the large cap PE firms, have started building their own internal consulting arm, who does exactly what my firm and some of our competitors do. But it's still a necessary thing. So, but they're just the big one, like the KKRs, the Vista Equity Partners. They have built out the internal arms to do that.
What's the disadvantage, real quick, between working at like a dedicated consultancy like Alvarez & Marsal or an in-house consultancy at like Vista?
If you're in-house at a company, you would only work on this particular fund or particular a cross fund, maybe if it's not too big. And then at Alvarez & Marsal, you are able to work, if you wanted to, across multiple industries, across different types of diligence. If you say, hey, I want to do commercial due diligence now, instead of operational due diligence, you have the flexibility to get cross-trained on these things. I think that's probably the main thing. But like I said, like a lot of these bigger, large cap funds, they poach people from consulting companies to come work with them. And it could be on the diligence side, and it can also be on the post-acquisition side, so on the operation side. So after they acquire a company, instead of hiring consultants, they have built an in-house team that kind of does what the consulting team would do.
Gotcha. Okay. Yeah. That makes a ton of sense. Now, I've got one last question before we get to our closers here, which is I've got to understand the role of the MBA in your career, because I'm someone who did an MBA. I'm a little bit biased, but a lot of people in finance and consulting say, oh, that's a thing of the past. It's a waste of time, not necessary. And yet you decided that it was worth it to go to Stern, get an MBA, incredible school, especially renowned for finance. Like I think that it's like one of the very top schools specifically for finance. And so why did you feel that that was worth the investment, and has that paid off?
Yes, it has paid off. I thought it was worth the investment. I think for people who want to go to MBA, get the MBA, they want to get very clear on what they want to do afterwards, and they want to make sure that the MBA can help them get there. I definitely feel the MBA helped me get to where I'm at, because I was doing more, general management consulting before my MBA, and then after my MBA, I did my MBA. I really wanted to get into M&A and private equity consulting, which I really think it helped me. Within my MBA, I did a concentration in finance and strategy. So I took a lot of heavy finance courses around, private equity, mergers and acquisitions, LBOs, all that. And then also I think that, one of the reasons that you do go to a top MBA is that you have the credentialization of that diploma, that piece of paper. So like when I apply for these roles and I have Stern on my resume, people just know like this is someone who's kind of been through the ringer when it comes to the academic side of things, and he has the IQ to be able to handle any kind of hard things. So I personally think it was worth it. Yeah.
That's great. Well, I'm glad to hear that it was an enjoyable experience. And so I'm going to close this out with the same 3 questions that I ask everyone who comes on the show. Just rapid fire, one sentence, whatever comes to your mind. Okay?
Cool.
So the first one is, looking back at your time in finance, what's one habit, skill, or technique that you still use today?
Putting checks in my models.
That's a good one. Yeah, people that forget to do that, they get busted models. Okay, second one. So if we were to look at your calendar and your bank statement, your credit card statement, what would it say that you actually value, Peju?
Eating out.
Any top restaurants?
Oh, there's too many. There's
Too
so
many. Okay, fair enough. Well, last but not least, then let's talk about one of my favorite questions from the How I Built This podcast, which is, given the mix between hard work and luck, which has contributed more to your incredible success in your career so far?
Ooh, that's a good one. I think a little bit of both. I think hard work for sure, because you have to be ready. You have to be kind of prepared, so that when the opportunity arises, that you're actually ready and be able to capitalize on it. I wouldn't be here where I'm at without people opening doors for me, people making introductions. So I'm extremely blessed that those things happen, but I also don't think that I would be where I'm at today if I wasn't ready. So the hard work comes first, and then when there's opportunities, you can capitalize on them.
Very interesting. Well, Peju, this has been an incredible conversation. We've talked about your time in consulting, why you chose that over finance, why you left finance, and why it might be a more interesting career in some regards than investment banking, even if I personally disagree. And so this has been a great glimpse inside the world of PE consulting, everything you need to know to get an analyst job there and climb your way up the ranks. So thank you so much for taking the time to join Wall Street Diaries, and I hope you have a great rest of your day.
Yeah, thanks for having me. Much appreciated. Yeah.
Bye-bye.